Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, after last week's show, we experienced a period where equity and bond markets faltered as bond yields and signs of bond market stress increased. Now, fortunately, this was bookended by periods where investors focused on corporate earnings releases, which provided a bounce for equity markets and some much needed stability for bond markets. Now, in last week's show, I mentioned how Amazon was due to announce its earnings figures after the show, and that perhaps they might take on even more importance and influence on which way markets would go in the short term. As it turns out, Amazon's earnings did just that, with equity markets teetering at critical support levels following recent weakness. And don't forget that US stock markets had just endured their worst day for over a year, while Amazon's exceptional earnings report beat analysts' expectations, and they pretty much saved the day for equity market bulls. Now, the impact of Amazon's blowout earnings was to send US tech stocks and equity markets more broadly higher. But, and there's always a but, new US economic data released last Friday showed an unexpected surge in employment the previous month. And Joe Biden greeted the news by saying that it was a sign that America's job machine is growing stronger than ever. However, investors took it as a sign that the US Federal Reserve may end up hiking rates even more aggressively. So the 10-year US Treasury yield exploded higher to 1.92%, while US stocks gave up most of their post-Amazon earnings gains. Now, by Monday, increased stress that we'd seen in bond markets was also evident in Europe as investors rushed to price in a series of potential interest rate hikes from the European Central Bank. Now, the problem is that the ECB has stressed that it would cease its large-scale bond buying programs before hiking rates. And it's these bond buying programs that have helped to keep a lid on the government bond yields of highly indebted countries such as Greece. Now, of course, rapidly rising bond yields increase the cost of servicing their debts. And so it sparked memories of the European debt crisis from over a decade ago. Now, if you recall, the debt crisis ultimately led to a number of European countries, including Greece, being bailed out and ultimately putting the Eurozone and the Euro under threat. Now, the strain beneath the surface of bond markets did subside somewhat as the week progressed, but even if investors missed the underlying strains in bond markets, they can't have failed to notice that the 10-year US Treasury yield hit 1.97%, while the 10-year UK gilt yield rocketed to 1.5%. And it continues to be a tough year for bond investors. Now, as mentioned, as the week progressed, bond markets began to settle down, with bond yields stabilising, albeit at these elevated levels. Now, this helped buoy equity investor sentiment alongside some strong earnings numbers from the likes of Disney, Uber, and Siemens, which offset some of the more disappointing numbers we saw from the likes of Credit Suisse. Now, it means that by the close of play on Wednesday, which was yesterday, equity markets stood on the brink of breaking out of their recent range-bound trading range, which on the S&P 500 in America is broadly between the 50-day moving average at 4,611 and the 200-day moving average at 4,450. Now, in the UK, the FTSE 100 is now just 1.6% below its all-time high achieved back in May 2018, and it's still enjoying the rally in energy stocks. Now, commodities also continue their rise, and it means that those investors with commodity exposure and exposure to the FTSE 100, or at least key components such as BP, but they're also underweight bonds and tech stocks, are having a pretty good 2022. There is also a certain amount of irony that with oil at a 7-year high, for example, that the rise of ESG and ethical investing has meant that many armchair investors don't have exposure to some of the best performing asset classes of 2022, which have mostly been those assets that have been driving or benefiting from inflation. And in fact, I've had commodity exposure for some time in my own 50k portfolio, which I run live for 80/20 investor members. Now, if you want to see what's in that portfolio, then of course you can take out a free trial. But ultimately, the market continues to try and work out where inflation will peak and how respective central banks will respond. So today's release of the latest CPI inflation number in the US was being billed as determining whether equity markets would finally break higher or lower out of their recent ranges. Now, many analysts painted the market's reaction to today's inflation number as binary, meaning anything above 7.25% would cause tech stocks to collapse once again, while anything below would potentially give the US Federal Reserve room to be less aggressive when tightening monetary policy. Now, this would send stocks higher, particularly tech stocks. But in the end, the CPI number was 7.5%, which is a 40-year high, and above analysts' expectations of 7.25 to 7.35%. And it sparked a pullback in tech stocks in the US and therefore the wider US stock market indices. As I make this show at the moment, the S&P is due to open down around 1%, while the tech-heavy NASDAQ is due to open down around 1.5%. Now, the initial negative reaction was reflected in Europe, but the FTSE 100 once again remains in positive territory for the day. Now, the 10-year US Treasury yield has risen to 1.98% following the CPI number, but the biggest moves can be seen on the shorter dated 2-year note, where the yield jumped from 1.354% to 1.434%. So don't forget, you will always see the biggest moves and reactions to potential interest rate rises in shorter dated bonds. Now, the US dollar index also jumped in value following the inflation data. However, recent history shows that market reaction is rarely binary. So I would suggest keeping an eye on US stock market indices into the close today and in the coming days to see if a trend develops. Now, once again, on the downside, keep an eye on the 4222 level on the S&P 500, but also the 50-day moving average and the 200-day moving average that I mentioned earlier in the show. And the other question you've got is, can the FTSE 100 continue its strong start to the year and finally reach its all-time high of 7,877? And will bond yields in the US continue to rise and break above 2%? They're very close to doing so as I make this show. And the other question is, will bond yields continue to rise in Europe and cause renewed investor jitters? Now, there's still that feeling that the markets are sitting on a knife edge and are looking for a sense of direction from central banks. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, Money to the Masses with the number 2. We're on Instagram, Facebook, TikTok, and of course, don't forget to subscribe to our YouTube channel.